Today, we're doing a deep dive into something pretty significant, but maybe flying under the radar a bit in India's financial world. It's this quiet surge, this big shift where Indian family offices, we're talking serious generational wealth, are moving away from, the usual assets and pouring billions into what are called alternative investment funds or AIFs. So, our mission for you, the listener, is to really understand the mechanics here. Why this pivot? Why are these incredibly sophisticated families changing how they manage their capital so fast? What's the big pull of AIFs? And maybe most importantly, what does it tell us about where India's capital markets might be heading, in terms of depth and maybe even self sufficiency?
It really is a seismic shift, you're right.
Yeah.
Traditionally, when you think about long-term Indian family money, you picture the classics, right? Huge chunks in legacy real estate, big stakes in listed blue-chip companies, maybe some steady fixed income. That was the bedrock. This move towards AIFs isn't just like tweaking the portfolio. It feels more fundamental. It's a change in philosophy, really. Prioritizing growth, diversification, risk-adjusted, of course, over just pure stability.
Yeah, that fundamental change is exactly what we want to dig into. Okay, let's unpack this then. Let's start with the scale. How big is this quiet surge exactly? We know it's big, but what are the actual numbers? What kind of money movement are we talking about?
Well, we actually have some solid numbers. SEBI, the regulator, put out data around April 2025, and it shows the total cumulative commitments raised by AIs in India. It's officially gone past 10.8 lakh crore.
Wow. 10.8 lakh crore. Okay, just for context, especially for international listeners, a lakh crore is 10 trillion rupees. So that translates to what? Roughly 130 billion US dollars, give or take, depending on the exchange rate. That's a market-defining amount of capital.
Absolutely. It's huge. And the speed, the acceleration, is just as striking. That 10.8 lakh crore figure, it's up sharply from just 8.9 lakh crore recorded back in 2023. So we're looking at a sustained year-on-year growth rate of over 20% in commitments.
Yeah.
That's impressive.
20% year on year. That's not just steady growth. That feels like a deliberate rush, doesn't it?
It does. It suggests a very intentional influx of capital, not just market appreciation.
And if you dig into who's providing that capital, that influx, it gets even clearer, right? It points straight back to the family offices we're talking about.
Precisely. The data breaks it down. If you look at where the new money came from during that growth period, nearly two-thirds think around 65% of those new inflows. They came specifically from family offices and high net worth individuals, HNIs.
65%. Okay.
Yeah. So it confirms they're not just, tagging along. They are the main engine here. Family offices are driving this AIF boom, putting in serious, deep-pocketed capital.
So if they're pouring that kind of volume in, how does that actually change what their portfolios look like? It's one thing to talk about the total market size, but how are individual family holdings structurally different now, say, compared to just 3 or 4 years ago? I think we have some insights from that EY India Family Office survey from 2024 on this.
Yes, that survey is quite revealing. It basically shows AIFs have gone from being this niche, maybe experimental part of the portfolio to becoming a core strategic piece. The numbers show allocations to AIFs have been growing on average between 30 and 35% annually within these portfolios.
30 to 35% annual growth within the allocation. That's huge for any asset class.
It's phenomenal sustained growth. And what that means for the overall weighting is significant. Family offices are now commonly assigning somewhere between 10% and 25% of their total portfolio value to these alternative strategies.
10 to 25%.
Yeah. Now compare that to where things were just 3 years back. For many, especially maybe the more conservative older guard, it hovered around a cautious 5%, maybe 10% max. So in many cases, they've doubled, sometimes even quadrupled their exposure to these types of growth-oriented, albeit less liquid, vehicles.
That jump from, say, 5% to potentially 25% is really telling. It signals real commitment, doesn't it? Not just dipping a toe in. It suggests they see AIFs as vital for long-term growth. And here's where it gets really interesting, structurally speaking. This isn't just the top handful of, the massive globally connected family offices doing this.
Exactly. The speed of adoption across the board is key. There's the IVCA 2025 report, that's the Indian Venture and Alternate Capital Association, confirms this trend is widening out fast across the whole domestic wealth scene. The actual number of family offices actively investing in AIFs, it's doubled since just 2021.
Doubled.
Yeah, doubled. It's crossed 170 nationwide now.
Wow. So when you have over 170 of the country's wealthiest families essentially making the same move.
It's not a fringe thing anymore. It's not some boutique idea. It's rapidly becoming a mainstream strategy for managing serious wealth in India.
Okay, That kind of synchronized movement really forces the question, why? Why now? What exactly changed? Was it the market, regulations, investor sentiment? Why did these traditionally cautious investors suddenly embrace AIFs so strongly?
I think we've pinpointed about 4 core reasons driving this pivot. Let's tackle the first one, the simple but vital factor of access.
Right, access is fundamental. Historically, it was tough for an Indian family office, even a large one, to get into the really high growth stuff domestically. Like, imagine trying to get a slice of the next big tech startup before the IPO or participating in a major venture capital round.
It was tricky, right? They might have had to use complicated offshore funds, navigate difficult regulations, or meet huge minimum investment sizes that just weren't practical.
Exactly. They were often kind of locked out of the best homegrown opportunities unless they went through very complex, sometimes opaque private arrangements.
So how do AIFs fix that? Well, AIFs are regulated. Domestic structures, that's key. They pool capital much more efficiently right here in India. They offer streamlined, much more manageable access to those crucial private market opportunities. We're talking pre-IPO deals, structured credit, private equity, venture capital,
Right.
the real growth engines. And these funds are categorized Category 1 for things like VC, Category 2 for PE, Category 3 for more complex strategies like hedge funds. That categorization immediately tells the family office what kind of exposure they're getting. That clarity, that transparency, it's a game changer compared to the old ways.
That makes sense. Clearer pathways to opportunities they couldn't easily reach before. And that flows right into the second factor, returns and diversification. Why are AIFs seen as better for this than just, say, holding a mix of listed stocks and bonds?
Well, the big appeal here is getting diversification that's not tied directly to the public markets. You know how volatile the Nifty or Sensex can be? AIFs offer strategies that can generate returns, or yield enhancement as they call it, that move independently. They're particularly good at delivering returns that potentially beat inflation, using methods just not available in the public markets.
Like what, for example?
Well, take structured credit. That allows them to invest in secured debt instruments, often backed by real assets. They can offer pretty high, stable yields, but without the day-to-day swings of the stock market. It's about sophisticated risk management, essentially, finding that alpha, that extra return in private areas that don't just follow the main market ups and downs.
Okay, that diversification and potential for higher returns makes sense. But let's play devil's advocate for a second. Isn't there a major trade-off here? If AIFs offer these benefits, aren't the families giving up the big advantage of traditional assets liquidity? You can usually sell stocks or even real estate relatively quickly if you need cash.
That's the critical question, absolutely. And you're right to bring it up. AIFs, especially the PE and VC types, category I and II, they are inherently illiquid. Capital is typically locked up for several years, sometimes 5, 7, even 10 years or more.
So how are they comfortable with that?
Well, the sophisticated family offices, they're factoring this in. Look at the allocation size, 10%
Right.
to 25% generally. It's significant, but it's not, say, 50% or more. They're managing their overall liquidity needs across the entire portfolio. They see this as a strategic long-term play. They're consciously deciding to accept illiquidity in part of their portfolio. Why? To access those potentially higher non-correlated growth opportunities that are crucial for building wealth across generations. For them, that trade-off, sacrificing some liquidity for strategic growth, is acceptable, even necessary.
Got it. A calculated risk within a broader strategy. Okay, let's move to the third reason, which I think says a lot about how India's financial infrastructure is maturing. Governance and trust. It sounds a bit counterintuitive at first, maybe. Why would a private investment vehicle need formal regulation to attract private money?
It's absolutely crucial. Think about who manages this wealth. Often it's professionals or family members responsible for preserving capital across generations. They are inherently careful, especially when it comes to compliance and knowing exactly where the money is going. India's history, like many places, has seen private deals happen under, let's say, less formal or sometimes opaque structures.
Right, less transparency, maybe more room for issues.
Exactly. So the huge appeal of AIFs is that they are mandatorily regulated by SEBI, the Securities and Exchange Board of India. This provides that institutional comfort level. It means robust reporting standards, clear governance structures, and oversight from a major regulator. It gives the family confidence that they aren't putting money into some risky, unregulated scheme. They're investing in a financial product that meets high standards, comparable to global norms.
So that regulatory framework builds the trust needed for them to commit serious long-term capital.
Precisely. Trust is fundamental when you're allocating millions or billions.
And that institutional feel, that structure and transparency, leads us right into the fourth reason, which I found particularly fascinating: next generation alignment. We're seeing wealth transfer to younger generations, right? And their approach to managing money can be quite different from their parents or grandparents.
Absolutely. This is a big cultural and operational shift playing out. Think about how many of India's great family fortunes were built, often on the back of massive real estate holdings or huge controlling stakes in their own operating businesses, maybe some legacy stock portfolios. Investment decisions might have been very relationship-driven, based on historical ties, or maybe advice from just one or two long-trusted individuals.
A very personal, traditional model.
Yes. Now contrast that with the next generation. Many are educated overseas, they've worked in global finance, they're exposed to institutional best practices, they tend to favor data-driven analysis, professional management, diversification. They look at the old concentrated legacy portfolio and see inefficiency, maybe even unnecessary risk. They want structures that are scalable, measurable, transparent, and frankly, more aligned with modern global finance.
So it's a shift from that deeply personal, perhaps slightly informal approach to a much more professional, institutional mindset. You can imagine, say, a 30-something taking over portfolio management, looking at a vast inherited real estate chunk, and wanting a cleaner way to deploy capital into growth areas they actually understand better. AIFs give them that vehicle, right?
Yeah.
A structured way to invest in tech or healthcare or renewables, rather than just holding on to grandfather's assets because, well, that's how it was always done.
It's exactly it. AIFs fit that modern professional profile perfectly. They offer access to external specialized managers, they have clear reporting, they allow investment into forward-looking sectors. It aligns with how this next generation wants to manage and grow the family wealth.
Okay, so bringing these four threads together: access, returns and diversification, governance and trust, and this next-gen alignment. What's the main takeaway? If we synthesize all this, what does it fundamentally mean for the listener trying to grasp this trend? It seems clear AIFs aren't really the alternative anymore, are they? They're rapidly becoming a core strategic part of modern Indian family wealth management. The strategic core, you could almost say.
I think that's a fair assessment, and the implications go beyond just the families themselves. This movement tells us something profound about the Indian economy overall.
Mhm.
It signals a real maturation, a deepening of India's own capital markets. We're seeing domestic capital become more sophisticated, more willing to take calculated risks, more patient, and crucially, it's becoming more structured through these regulated vehicles. This is domestic confidence being channeled directly into domestic growth opportunities. It potentially reduces reliance on foreign capital for key growth sectors down the line.
So building internal capacity.
Exactly. And the central insight for anyone watching this space, I think, is that the families who are adapting now, making this shift early, they're not just positioning themselves to preserve wealth against inflation or market swings. They're actively positioning themselves to help define the next chapter of Indian investing. They're becoming key capital providers for the future of the Indian economy, using these sophisticated, domestically regulated tools.
That's a powerful point. They're capitalizing the future from within. And that leaves us with a final thought, something provocative maybe, for you, the listener, to mull over. If this trend keeps up its pace, if Indian family capital continues flooding into AIFs like this, potentially displacing some of those traditional assets, how dramatically could that change where India's most promising private companies and startups get their funding from? Could we see a major shift away from the historical reliance on international VCs and institutional investors towards this incredibly deep, sophisticated, and patient pool of domestic family capital? What would that kind of financial self-reliance mean for the future landscape of Indian innovation and entrepreneurship? Something to think about.